Good morning, and welcome to the last session of the LuxFLAG Sustainable Investment Week 2021 version. I'd like to start, though, by taking a moment to thank you all for your support during these last difficult months since the tragic passing of LuxFLAG's General Manager, Sachin Mankalis. Sachin was a great human being and a tireless supporter of sustainable finance and a pioneer in many ways. He exemplified LuxFLAG with his passion, ambition, and drive to move to a sustainable future. So thank you very much. As chairwoman of LuxFLAG, I'm very pleased to see that after 2 editions, the LuxFLAG Sustainable Investment Week has gained recognition, and that is thanks to LuxFLAG's associate members who are showcasing this week and have showcased this week where they are in the sustainable finance journey. And given the finance industry is at various stages of that journey, this week has been about sharing best practices so we all advance towards the goal of making all finance sustainable. For this 3rd edition of the LSIW, again, we had a fantastic response with over 3,500 registrations for all of the sessions during the week, which is really, truly amazing. And I'd like to thank our host partners and media partners for that. The 25 sessions over the week have covered the latest trends and most pressing issues in sustainable finance, and we hope you find them and today's session right now useful and inspirational, and in terms of showing the progress being made to harness finance to help find solutions to our current environmental and social challenges. A few housekeeping points: the slides and the recording of all of the sessions will be made available to you in a week or so. And for the Q&A, please do ask your questions. They would be great. That would be greatly appreciated. You can either put your questions in the Q&A, which is you'd find at the bottom right of your screen, the 3 dots, or put them in the chat if that doesn't work. So I'm very pleased to introduce this session hosted by ING. Again, the last session of a very full week. Today's topic is sustainable finance and the role of banks as enabler of the green transition, the view of ING Bank. And speaking on behalf of ING today is Jan de Jaak, who is Sustainable Finance Lead, Wholesale Banking Belgium, Luxembourg, and Nordics for ING Bank. Just a few words about Jan. He started his career within the waste management industry and joined ING in 1999. From 2007 onwards, he became Global Relationship Manager for corporate clients across the Nordic countries, focused on Finland, and complemented with the Baltic region in 2017. And he started as Sustainable Finance Specialist in early 2019. And finally, Jan is a client-focused senior banker with a passion for sustainability and a drive to be a step ahead. So Jan, the floor is yours. Thank you.
Thank you, Denise, and my pleasure to speak to you all today, indeed, with the guidance on how a bank like ING can support the transition to a more sustainable economy at large. Now there are 2 topics what I want to guide you through, basically the role of the bank as such as one item, but also how we see the market evolving on sustainable finance. And it is clear that the evolution and the trend has continued to pick up massively during 2021. Maybe first, kind of a mission statement from ING's perspective. We believe sustainable business is better business. And that transition towards a more sustainable economy is supported as a bank through our balance sheet commitments, by financing change, by basically really looking at the transition logic of our clients. Sharing sector knowledge is therefore key, with a focus on the business profile of our clients. So being sustainable as a bank is not just about our own operation as an institution, but also really making an impact through the choices which we make as a lender, as an investor, and through the services which we offer to our clients. So as such, we believe that sustainability is inherent in the purpose of empowering people, which is basically one of the key missions from ING's perspective. Now, what does that mean when it comes to sustainability within ING, and specifically the sustainability direction which we have set forward? There are 2 key aspects linked to this, and that relates back to the logic of the definition of sustainability by the UN. Of course, you need to look at environmental logic, but also the social angle is very much important. So hence we have defined 2 strategic focus areas. 1, climate action. 2, financial health. And on both I will comment and give some specific examples how we at ING specifically want to take that forward. So on climate action, we believe there are 4 specific points where a bank can support the transition to a green economy. First, it's about our own actions. Secondly, it's about the financial solutions which we offer to our clients in the transition pathway towards the goals which are set as we speak, for instance, within Europe by 2030, 2050. It's about aligning our lending portfolio towards those goals of a max rise in temperatures of 1.5 degrees Celsius, what we call the Net Zero Banking Alliance and Project Terra. And it's about setting the market, about steering how we want to see the market evolving, about cooperation, about leveraging the impact we have as an industry. So those 4 areas are linked to the section of climate action. The first topic is what we do as an institution, ING corporate, how we manage our own footprint and our operations. You see a number of topics being quoted. One of those, for instance, is of course managing energy consumption at data centers, looking at renewable energy sources to feed for electricity. But also when it comes to real estate, we have, for instance, the new headquarters in Amsterdam since, I believe, 2 years, has reached the highest BREEAM certification possible in the Netherlands. This is guiding what we do across ESG logics within the industry as our own operations. But more importantly, when it comes to making a change towards sustainable economy and how we can leverage as a financial institution is of course what we are financing to support that transition, which means in the service offering we have to our clients. And therefore we are a key facilitator. What we do is leveraging on the deposit base by the asset which we make being a financial institution. For instance, when it comes to sustainable improvement loans. I will explain shortly with more in-depth guidance, but also when it comes to specific use of proceed possibilities across the loan and capital market, green bonds, green loans, which as we know are bound by voluntary but guiding market standard principles, by the ICMA, by the LMA. We offer solutions specifically to looking at green finance frameworks. We provide solutions when it comes to overlay sustainability logics in the supply chain, where, for instance, an ESG rating can be linked to the advance rate of a supply chain finance program. We, of course, manage the portfolio when it comes to the mortgage portfolio of the bank in our home countries, which is a massive exposure which we have. And therefore, it's important to manage the EPC certification targets of those portfolios, which is then residential real estate. But also in commercial real estate, we have a dedicated focus, how we should look to change and to support the transition towards a lower carbon energy consumption, for instance, in real estate. You see some kind of other quotes here, sustainable investments. Clearly there we have possibilities to look into supporting companies through equity-like structures. And also when it comes to non-recourse financing, we have a dedicated team supporting our clients specifically on non-recourse financing with a sustainable logic. But maybe as an example specifically, as guided, let me deep dive a little bit on the sustainability improvement loan, and which is called by the LMA sustainability linked loan. Now this was set in the market by ING 4 years ago, a little bit more than 4 years ago, with the first deal on the Royal Philips Group. Since then, clearly the market has evolved massively, and by now more than 350 deals has been posted throughout global world, basically throughout all the continents, with a clear market share around 70–80% in EMEA region. Now, what is the key logic here? This is typically a general corporate purpose facility, which is tied to specific targets, KPIs, could be an ESG rating, could be company specific KPIs across ESG material issues. So with that, you align your sustainability strategy with basically the funding. It's an interesting opportunity for funding diversification, and you will have the benefit to potentially reduce margin if you reach the target. On the other hand, if you don't reach the target, there will be also a premium applied. That fits into the logic of an increased risk when it comes to the entire profile of a company, and the execution of sustainability ESG strategies. Because what we see more and more is that climate risk and ESG strategy execution will have an impact on the overall risk profile of a company. Now, as guided, this is linked to the LMA guiding principles of the sustainability-linked loan market. That is what you see here. I will not go through all the details of this slide, but clearly you have to keep in mind a number of logics which are key when it comes to setting up such a structure. I think first it's about smart selection of KPIs. Smart selection of KPIs also means defining ambition level, defining the annual sub-targets, because you will have an annual performance check to be done to assess as to whether you have reached the targets, to then have a subsequent margin impact. You will have the requirement under point 5 of this guidance, at least the strong recommendation from the LMA, but we found it is important to have it merely as a requirement to have specifically the auditing on the data points through limited assurance, because that of course gives comforts to the banks when it comes to the available data on the KPIs. And that means that you will set indeed a group view wide target incorporating in the facility through such a mechanism. And that has clearly something, this has been clearly something which has massively picked up in the market the past years. Now, why should companies engage in sustainable finance? I think it's clear there are multiple benefits, as you see here on this slide. It's about protecting, but also enhancing companies' value. And that is something we see happening as we speak clearly. It's about reputation. It's about materiality of ESG issues through and materiality assessment. And typically more and more corporates are disclosing their materiality assessment and their diagram in their non-financial reporting. That is an important topic to look at. It's about internal alignment. Internal alignment, because indeed, it's not just about the finance or treasury department looking at it. It's about stakeholder engagement, the full logic. It's about the value chain of a company, the stakeholders at large, the suppliers, clients, the full logic of the entire stakeholder group. And indeed, by defining a specific strategy on sustainability execution, you will have the possibility to drive forward your ESG recognition as a company. Now, linked to this, I think it's interesting to share a few market trends as we see them happening throughout 2021. And of course, when we start comparing in the history, then it's important to look at, okay, where have we been past 3 years and eventually also last year. Now, we all know we are still partly in that COVID situation that has in Q1, Q2 last year, I would say, subdued the demand in the market. But clearly since then, second half 2020, we have seen a clear pickup in the market demand when it comes to interaction with advisors on sustainability execution, but also when it comes to specific sustainable debt market. I will explain going forward with an update on how the market on sustainable debt has evolved the past years. So it's an increased strategic importance when we talk with clients. More and more, it is indeed CFO, CEO level. Strategic discussions being done and cross-functional teams being represented, meaning group sustainability strategy, investor relation, eventually procurement, and finance treasury. It's a combined effort to make the link between sustainability and finance, and as such drive that execution forward. It is also fair to say that I think the past years, and that's another evolution noticeable in the market, there is a lot of technical innovation noticed within corporates. Technical innovation on solutions to have a lower carbon footprint. And that requires specific funding, specific financing, which we see picking up, and where we have, as an institution, as ING, in the logic as just explained, clearly a lot of requests coming in to look at possible projects and how to fund. And then we have another angle where we look into, of course, it's the EU taxonomy. I will also guide you through that a little bit. Now, when it comes to climate action, so two things have been explained, but the key topic and the key leverage we have as a financial institution is really through our asset commitments. That's the biggest impact we have on climate through the financing which we do. That is what we call Project Terra, where we look at 9 industrial sectors which have, according to us, the most greenhouse gas emissions globally, are linked to the direct global emissions as you see them listed here. And the sectors which we have defined are also linked to the asset commitments we have on the balance sheet of ING. So these are sectors where we have large commitments and where we have in our 600 billion asset book an important consideration. As you see them listed, you have classical sectors well known, fossil fuels, power generation. You have the entire logic of transport and logistics across the logics of transportation, and you have real estate, commercial and residential real estate as a sector. And what we have done specifically is to work together with a number of parties to get data on assets specifically, to look into logic of how to measure, how to align, and how to report on the entire logic of what is now steering a sector towards the max 1.5 rise in global temperatures. And ING came up with this commitment already in December 2018. At that time, to align with the Paris climate goals, which, as we know, is guiding to a max 2 degree and, if possible, 1.5 degree rise in temperatures. And we have now basically updated our commitment with a net zero banking alliance, which means by 2050, we want to reach that and cap it to max 1.5 degrees. So how does that work specifically? It means that for these industrial sectors, we will have to work on transition pathways. And there are many examples as we speak available. For instance, in the automotive industry, it is clear there is an ongoing trend to change from internal combustion engines towards electrification and electric vehicles. But also in real estate, there is a lot of more efficiency on coming upstream when it comes to the products available for lower carbon, when it comes to energy efficiency in building new assets, whatever asset class it might be. Is it a logistics asset? Is it an office building? Is it other residential real estate? To the full logic of that sector, there is an important trend noted as well. And in many heavy industries, a lot of companies are really investing into lowering the footprint, moving towards the transition of low carbon economy. So what we look at from each of these 9 sectors is, of course, the value driver in each of these. The value driver, for instance, oil and gas, is the upstream market. Because upstream is the key, of course, and the baseline for all the rest and the remaining when it comes to distributing and so on. We look at specific matrices, and most of the matrices for all these segments are CO2 intensity linked matrices. So the full detail of these kind of analysis is available in an update which we have made most recently, which we called our first integrated climate alignment disclosure. For the past 2 years, we have disclosed the evolution of the trajectory of Project Terra, what I've just shown. But this year, last month in September, we have released an integrated report, which takes basically a dual angle. First, how we as a bank impact climate through our financing, but also how climate risk could impact the bank. And eventually, it is clear that the regulator will also require banks to assess, when it comes to credit risk, to assess properly what is basically climate risk for clients in that logic. So this has now been compiled in a first overview and report, which I think is a very interesting one to read through, to get the glance of how we look at it and how we want to report on it going forward. A few key topics specifically noted on the bottom end of the slide. So of the 9 industrial sectors which we have guided through before, 5 are aligned with the pathway which we have seen as being committed to. And that's, of course, a very good baseline to start from and to further steer our portfolio. For instance, in the power generation, as you see it quoted here on the left side, the outstanding of the power generation sector in the balance sheet of the bank, 64% of that segment is basically linked to renewable energy. Also for the upstream oil and gas, we have specifically monitored and guided that we want to reduce our exposure and outstanding to this specific segment with 12% by 2025 versus baseline 2019. This is a commitment in line with the International Energy Agency trajectory for the industry. So it's important to keep in mind that when we have a certain pathway for an industry, we of course benchmark with the regulator, with the industry itself. And for the power generation, it is clear that International Energy Agency is the authority to look at when it comes to those pathways and when it comes to science-based logics on the migration towards low carbon economy. So I would encourage you all to clearly look into our global website and read through this document, because I think there is a lot of information which is certainly valuable. As a fourth point within the climate action logic, it is clear that we can't do this alone. We can't do it alone as an institution. We have to team up with many people, with many sectors, but also as an industry itself. So we have to leverage on the industry segment and cooperate. Cooperate meaning we have to look into the sector logic. We have to deep dive into materialities of certain aspects like circular economy, where in 2018 already we have jointly with 2 other Dutch banks provided circular economy finance guidelines. Because also there the upcoming taxonomy will provide further guidance on, okay, what is then assumed to be circular economy and how can it substantially contribute as an activity. We are a member of certain working groups when it comes to the ICMA or when it comes to the bond market, to drive that also forward, to see how we want to how we want to see standards in the market being applied for the industry. And I think that's an important logic, because of course we have to adhere to certain market standards. And in this respect, also ING 2 weeks ago has released a position paper specifically on the sustainability linked market, which covers both the loan and the bond market, with a few guidances and considerations on how we want to see sustainability linked market being structured when considering those solutions. So this was specifically on climate action. Now, financial health is, of course, part of, as explained, part of the strategy, sustainability strategy of the bank. And it's, I think, equally important because we know that many people have challenges as we speak when it comes to their financial health position. So we want as an institution to contribute to a financially healthy society, to specific innovations, specific involvements or information sharing. And this relates primarily to our more than 38 million retail clients across the regions which we have through ING. So you see here quoted a number of initiatives which we've done and where we have specifically taken this strategy forward. Across regions, it's not only in the Netherlands, Romania, but also obviously in all kind of countries where we are operating. This program from the group is being represented and being taken forward in the regional countries as well. Now I have a few topics specifically on the market evolution. And I think that's an interesting one to look at, because there it is clear that the market has evolved massively the past years and eventually also in 21. Now with this, I wanted to give you an overview on the regulatory scope when it comes to ESG. And we know the EU Green Deal has been set in stone, has been released about 2 years ago by the new Commission with specific action plans on sustainable finance with specific sub-segments when it comes to industries like circular economy, like the focus on biodiversity. And each of these programs will have to be kind of further substantiated with action plans. Now, the most imminent pressure we have from, and then I'm talking about society at large, from a regulatory perspective in Europe, is clearly the EU taxonomy and the EU Sustainable Finance Action Plan, because that will be a binding regulation coming in with reporting requirements, with specific requirements to report for corporates, the percentage of sustainable revenues and related capex, but also with clear reporting requirements on investors and to which extent they have invested in sustainable assets. It will also define what is green and what is not green when it comes to an industrial activity for a number of industrial sectors, and as such have specific thresholds being incorporated through what I define as a sustainable activity, environmentally sustainable economic activities. So for each of those environmental objectives which have been set in stone by Europe, there will be delegated acts coming up, and 2 have been released in April this year on the first 2 topics, so climate change mitigation and adaptation. But then again, we have seen the first release of the draft in August when it comes to the 4 other remaining environmental objectives. And there was a consultation period which has been closed recently, so we can expect, I think shortly or early next year, to have a new delegated act coming up with the remaining 4 environmental objectives. It's important to look at, when structuring green funding, the guiding market principles. So when we talk about the ICMA or the Loan Market Association, those are voluntary market standard guidances, which we apply today in our structuring. But of course, we will always look at, okay, what is now included in the EU taxonomy, because that will define the future for the transition pathways and also which thresholds are included depending on which industry. So there is a lot of information and a lot of guidance to be given in this respect. It's not the topic of the presentation today, but clearly there is a lot to speak about when it comes to the regulatory angle of sustainable finance. The underneath section of the slide specifically looks at risk and supervision, and that will of course link back to our industry, because the European Banking Authority, European Central Bank, they're all looking into a climate risk approach and how banks will have to disclose that assessment on their portfolio, but also how we should indeed involve and support a greener economy. And that's the leverage which we have as just guided when it comes to the logic of being a bank. Now, the sustainable debt market, I have still 2 slides incorporated to give you a glance on how we have seen the market evolving. What's first? 2 slides included specifically from Bloomberg data. So the right-hand top end, there you see the exponential growth of the market specifically from 2012 till 2020. The blue bar is green bond, the green one is social bond, the yellow is sustainability-linked loan, and then you have green loan in red. Exponential growth, I think if you compare the evolution, it's obvious and clear that green bond has been initially kind of driving the market through several issuer categories, being it SSAs, being it corporates, being it indeed governments and so on. And then we have seen a massive pickup in the overall corporate market, where also green bonds have been issued massively. Now, last year, through the COVID situation, there was an interesting trend noticeable, which is the green bar, the social bond, which is of course linked to the situation of COVID, and where many issuers, depending on the industry, have decided to have use of proceed categories linked to social targets. And that's an interesting evolution, which is important going forward, because when we build back better after COVID-19, it is clear that it's about integration, about social and environmental topics into the execution of a sustainability strategy. We have to keep in mind the social angle as well, which typically always come up in a materiality ESG assessment, also when you look at ESG rating providers. Sustainability linked market has also clearly grown. The yellow bar as guided, a sustainability linked loan effectively was invented and set in the market by ING more than 4 years ago. So hence you see the first yellow bar in 2017 continue to increase, but then you have also seen the spin-off and the split in the bond market. The sustainability linked bond market has also massively grown the past 2 years. Maybe a more up-to-date slide when it comes to this year. So the last one was just looking at 12 till 20. This is then looking at 21 first half, including across categories, full logic of the debt market, loan and capital markets. I think clear conclusion, if you see the bars here, the 2021 volumes in sustainable debt first half have already exceeded the levels of full year 2020. So then you can say, okay, fine, but we have seen a subdued activity in Q1, indeed, due to COVID. Clearly, second half last year, there has been a pickup again. And this trend has now clearly accelerated, partly because in 21, many aspects come together as we speak. Many aspects come together in the sense that we see the regulatory pressure coming up with the reporting requirements as of next year over 21. We see that the IPCC new climate report basically made it clear that the decade which we have now entered is basically the one to work towards the max 1.5 degrees rise in temperatures. So we have another 10 years to make it work as a global society. And that, of course, triggers companies to do the necessary investments and to look into sustainable funding across categories. What is also an interesting conclusion or guidance here on this slide is specifically looking at the regional split between continents, Americas, Asia Pacific, and EMEA. If you look to the history of 12 till today, historically, the majority of sustainable debt was issued in EMEA region. There has been a clear pickup in Asia Pacific and Americas, and specifically Americas also since 21. And that I think is partly linked to the new presidency coming on, which of course will help as they have subscribed again to the Paris climate goals. So the market, as we see it happening, is a trend which is set in motion through several aspects being quoted. And that is something where we believe that the industry will clearly continue to work on, and where the leverage we have as a bank is to steer our asset commitments in line with the Net Zero Banking Alliance. So it's sharper than the Paris climate goals effectively. And that is something where we are truly committed to make it work. And that is about really engaging with our clients to understand how they have to migrate throughout the transition and how we could support them with the financing and financial solutions. I think with this, I would like to open up for questions and look forward to have a dialogue on this.
Many thanks, Jan. That was really, really good, really excellent, and great to hear what a bank, a leading bank in terms of sustainability as well, such as ING is doing on the ground, and obviously you're a global bank as well. So that's really interesting to hear. We have I have raised some questions, and we have some other questions in the chat. First, there's a couple of questions relating to the sustainability-linked loans. So just maybe the first one, what is the take-up by corporate clients for sustainability-linked loans? Is that sort of carrot and stick approach working? Obviously, with the ultimate goal of making a transition to a sustainable future.
Yeah, a good question indeed, and maybe I can directly refer to the name which we apply within the bank for the solution. So the LMA calls it a sustainability linked loan. Within ING, we call it a sustainability improvement loan. So it's all about improvement towards a sustainable economy. And that means that we have to provide support to improve towards a lower carbon trajectory, which means execution of the KPIs by the target setting, medium-term target setting with an annual performance check to make sure that we support that logic with indeed a financial incentive. So the baseline for this solution is truly the execution of a sustainability strategy where the corporates are indeed doing that and having then the link towards the financing solution with a possible margin decrease as a consequence.
Okay, no, thank you for that. And there is another question relating to that. So how much control does ING exercise over the choice of KPIs for the sustainability improvement loans versus those that the client indicates? Your point about choosing relevant KPIs and material ones is good, but what happens when clients choose KPIs that they think will make it easy to reach the targets rather than stretching to achieve improvements?
Interesting question, and indeed, that's certainly a good question. We work on the basis of voluntary market standards as guided. The sustainability linked loan principles by the LMA is market standard yet voluntary. So there are a few guiding principles, but then again, it's about aligning and defining the ambition which we want to see adhering to in the market, which means that we will do indeed an in-depth discussion and conversation with our client to make sure that we understand where they want to go to on their pathway through the selection of the KPIs. For instance, CO2 related KPIs typically these days more and more will be SBTI linked when it comes to the target, so confirming the 1.5 max pathway. That is, I think, important as well. And the leverage we have as being a sustainability coordinator, of course, then we have really the in-depth dialogue with the client. And then when we coordinate a deal, then we have the leverage to make sure that it is where we want to stand, where we want to see it. If we are just a participant as a bank, then of course we are a participant and we can challenge certain ambition levels, but we can't move the needle when it comes to the structure itself. However, when we have been structuring it, then of course we want to adhere to certain market standards, and that was also the reason why we have released that position paper 2 weeks ago.
And I guess actually, I mean, of course, this is the whole challenge with the transition, isn't it? Is getting from here to our goals and having to calibrate, right, the KPIs and expectations, and making that judgment. I imagine when it's time to up the standards it will be an interesting one, put it that way.
Certainly indeed, yeah.
Okay. Perhaps now just moving on to the educational side of things. I have to say, I know ING is investor education and financial education is one of my passions, if you will, as well. And I really have to applaud ING for your long-standing efforts in respect of financial education and as you described, financial health. I think it would be interesting to hear a bit about, how much of a need is there in addition to financial education, but education about ESG in terms of and how finance actually enables the green transition. At the level not just of within your organization, but also at the level of corporate clients, and then maybe separately with retail clients. Is there still a lot of education required?
If you would look through the full logic of our clients, indeed, across wholesale and wholesale clients, so basically the corporates and the mid-corporates, but also then the retail clients, it's fair to say that indeed, I think there is still a lot to be done when it comes to educating and making sure that everyone understands what ESG stands for, what is the scope when we talk about ESG or sustainability. What does it mean exactly? It's clear that there is a lot to continue to learn towards our clients in that respect. But then again, it is also clear that there has been a massive pickup the past years in the understanding on it. And what we see in our client dialogue, and specifically when it comes to the wholesale bank corporates of these worlds, there is a clear trend that everyone is looking at it. Everyone is looking at it, and it's more and more a kind of strategic discussion on the pathway for the company going forward. When they define the medium-term planning, they will look into considerations on sustainability. And that comes from investor pressure, that comes from board of directors, and that they will have to execute throughout the process. So it's a clear underpinning of the market evolution as we see it happening. And advisory is, of course, key in order to make that work with the focus on the sector. I mean, you have to get the sector knowledge. You have to understand how the peers work within their sector. You have to see how the transition is made within a certain industrial logic. And if you combine that entire logic, then indeed, I think you can make a difference.
Maybe linked to that question, and also I guess with the introduction of the EU taxonomy, I think that and this is maybe more on the retail side of things, but do we need to educate retail clients more to understand that we are talking about a transition? Okay, it's one that has to happen quickly, but that obviously to achieve that transition, we might need there will have to be loans, and financing made to companies with today less green or so-called brown activities. I mean, I think that's a little bit of a challenge. I think even in the media, I think it's a bit of a challenge.
I think that's a fair point, and that's why we have also guided that it's about cooperation across industries and across segments, basically also with support from governments. We need regulatory guidances when it comes to EPC certificates in residential real estate for retail clients. And that's something where indeed a lot has already evolved, but it will continue to be so to manage the footprint of residential real estate, which links then back basically to a large extent to retail clients, because there, I would say, most of people are owning a house, and if they invest in a mortgage loan, then of course they will have to look into the EPC certification logic as well. So that trend is clearly happening as we speak.
That's good, because it's true. It's important. It's important, for the green pieces of the world, what have you, to push the industries and push the financial industry, to go obviously more towards a green transition. But it's also important that everyone understands that it is a transition, and there are steps to be taken. And as you say, the reporting. Yeah. Sorry, go ahead.
No, indeed, yeah, and that is why it's very important, I believe, to really have an in-depth dialogue with our clients to make sure that we understand where they want to go to and how we can advise them on the trajectory linked to their industry.
Agreed. A lot of work to do. Jan, I think that's it for the questions. I don't know if there was anything else you wanted to say or to close your part of the session.
No, just thank you to be able to present indeed the view of ING, how we can support the transition at large as a financial institution. It's close to our heart, and it's a part of our key strategy. So look forward to continue working on this execution.
Thank you, Jan. And there's a lot of work that is, so I'm sure we will see each other very soon. So thank you so much, Jan. It was really a very good presentation, very good discussion. We can really see a lot is going on, and it's quite encouraging to see what's happening at ING, and I'm sure, and I know elsewhere as well. So this actually wraps up the 2021 edition of the LuxFLAG Sustainable Investment Week, with over, as I mentioned, 3,500 registrations. Over the week, I think we can say that the topics covered by our speakers resonated with many. We hope you were inspired by what you heard, and that the sustainable finance best practices, challenges, and opportunities discussed will help you in your journey to make all finance sustainable. Many, many thanks to our host partners and to our media partners for your contribution to the week. And thank you also to the LuxFLAG team for all your behind-the-scenes work for making this happen. You're really a great team. So finally, I know it's the end of a long week, but we are already thinking about the 4th edition of the LuxFLAG Sustainable Investment Week. So if you have any comments about this year's event, please don't hesitate to send us a note at info@luxflag.org. And finally, I'd like to end the session with a quote that I hope will resonate with you. And actually, it was originally said by LuxFLAG's late General Manager, Sachin Bankalas. We now understand that sustainable finance is not just another type of investment, it's a complete shift of mindset. So thank you very much. Have a wonderful end of Friday and a wonderful weekend, and take care. Bye-bye.